While I was away scanning headlines, the story for Australia was really house prices. Falling in Sydney and Melbourne particularly is increasing. Auction rates were falling. No one was showing up to auctions.
The market is softening, but prices, are still wildly out of step with incomes. Like, if we actually want housing affordability to be a thing, we should expect further falls.
Absolutely. Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name's Bryce.
And I'm Ren, and today we have a massive episode for you. We are back after 5 weeks. More specifically, Bryce is back after a 5-week holiday.
Yes.
And for people watching on video, they can certainly see a tanned and refreshed Bryce.
There is a bit of a difference between the two of us, but...
But look, what a 5 weeks it has been. We did our Decade Ahead series. We covered 10 themes for the next 10 years. But whilst we were releasing those episodes, heaps was happening in markets. You picked a good time to go away.
You can't take a holiday.
No, well, you certainly can take a holiday. So this episode, we're going to just unpack everything that's happened over the past 5 weeks and help you make sense of it. Because from AI to earnings season to the broader macro picture, we're going to cover it all and then close it out by coming back to Australia and talking about what it means for us here down under. But this is truly going to be, a global look at the investing picture because there's plenty happening all around the world. Before we get into it though, Bryce, give us a cliff notes of your holiday.
Cliff notes. It was a fantastic holiday. Spent 5 weeks in Europe. Very fortunate to be able to do that. London was good. Caught up with family in London. Had some time in Ireland. Hired a car. Went through the Wicklow Mountains. If anyone hasn't been there, highly recommend.
Nice.
Then Italy. We were in Piemonte for a little bit and enjoying the Barolo red wine. Very famous.
Yeah.
And then a couple of weeks in Greece. We did Milos and Sifnos, 2 small islands. Island hopping and enjoying the local cuisine. Nice. It was good. It was very good.
Sounds good.
But I'm back. I'm refreshed. I kept an eye on what was going on. It was sort of a bit hard not to with some of the headlines that were coming through. But I didn't touch my portfolio. Didn't open my stocks.
Nice.
Looking forward to unpacking everything.
Are you going to ask me what I've been doing for the last 5 weeks?
I know what you've been doing. What have you been doing?
Well, glad you asked. So it's been a busy 5 weeks here at Equity Mates. A lot happening. We should shout out some of the shows that continue to be produced. Get Started Investing continues to go from strength to strength. 2nd episode launched, How I Got Started. So if you want to hear how everyday people in the Equity Mates and Get Started Investing community are investing, head over to that YouTube channel or podcast feed. There's now 2 episodes a week hosted by Jess. But Bryce, the other exciting news is that FinFest continues to be planned away in the background. More than 70% of tickets are sold.
Yeah.
So if you haven't got your ticket yet, make sure you do.
What is FinFest?
FinFest is Australia's biggest investing festival. More than 2,000 people down at Carriageworks in Sydney on Saturday, the 24th of October. 5 stages, food trucks, bars. It's going to be the interesting information of an investing conference with the vibe of a food and wine festival at a time and at a ticket price that everyone can attend.
Yes.
No longer held at 11 o'clock on a Tuesday like so many investing conferences are.
Yeah.
Now, the big exciting news is we are close to being able to announce our lineup.
Yes.
And there's some big guests.
Yes.
Which I'm just going to tease for now because we can't quite announce it yet. But if you haven't got a ticket, you're going to want to get one because you're not going to want to miss it.
Yes. Thank you to the 1,400 odd people that have already bought a ticket without knowing anyone that's going to be there.
Yes.
We are so close to announcing a lineup that is going to be on par with some of the best finance events globally. So let's just leave it there and grab your tickets because you don't want to miss it.
All right, well, let's get into it. A lot happening in markets. Let's start with the AI wild ride because that was really the story while you were gone, and that kind of then leads into what we've seen in earnings season. So the story really starts with the picks and shovels for data centers who have been just the biggest winners of this whole story. And an index that has become more and more popular recently is the Philadelphia Semiconductor Index, or the SOX, S-O-X. The reason it's become quite popular is because in 2026 up to sort of early June or mid-June, it had more than doubled.
Yeah.
And this is an index that includes, the likes of Nvidia, AMD, Intel, a lot of the
30 companies.
a lot of the companies that have benefited, American companies that have benefited the most from this huge data center investment wave.
Yeah.
But then as you were gone, Bryce, the market turned, investors got nervous, everyone worried about how sustainable the AI trade was, and the stocks fell more than 20%, fell into a technical bear market. And some of the high-flying AI names also dropped with it, none more so than SpaceX.
Yes. Now, this is one stock I did keep an eye on because before I went away, I said, if SpaceX doesn't drop below $150 in the next 12 months, I'll stop investing. It was ripping when we were talking about that. I think it got as high as almost $200 at the time. Luckily for me, it didn't maintain, and it is now as low as $108.
Yes.
And so that's down about 40% since its post-IPO high, but not surprising. It has just reported, and we'll get to some of its reporting numbers in a moment, but to be expected. Valuation was crazy. People have made their money. People are starting to sort of sell.
The float was incredibly tight. Like just 5% of SpaceX shares were traded. Now post this earnings season, a number of shares get released and it's going to be 12% of the company's shares can be traded. We don't get things right all the time here at Equity Mates, but I'm proud that we really went out and said, don't buy, it's overvalued, it's going to fall. And there was a lot of comments, people saying we don't understand the technology and we don't understand how generational a company SpaceX is. We do.
Yeah, we do.
It is a generational company.
Yeah.
It has pioneered reusable rockets and made space affordable. Starlink is going to be one of the best businesses of our lifetime. And yet, the economics of what it was trading at didn't make sense.
Yeah, we understand valuation.
So it'll be interesting to see where it goes from here. To jump ahead to the earnings season conversation, in Q2, they reported $7.8 billion in revenue for the quarter. Pretty good, up 92% year on year. But how's this for an Elon Musk-esque estimate? The CFO said they're on pace to do $100 billion in annualized recurring revenue by the end of the year.
I mean...
They did shy of $8 billion in the quarter.
Yeah, it's unbelievable. I think it has further to fall. We still haven't even seen the sell-offs as the unlock periods come from some of the bigger investors. So the pressure to sell will still continue.
So the SOX was down into a technical bear market, down more than 20%. SpaceX almost halved from its post-IPO high, but the biggest canary in the coal mine of AI jitters, shall we call it, is Oracle. Oracle is the company people are most worried about. If things do fall over, it'll be the first to fall. It's been cut in half. It's down more than 50% from late 2025. Its share price is down more than 50%. For people who are unfamiliar with Oracle, it's a old school enterprise software company that has gone hard into AI data centers in the past couple of years. Briefly, Larry Ellison, a couple of years ago, Larry Ellison, the founder, was the richest person in the world.
Yeah.
But since then, the share price has been cut in half. But interestingly, Oracle has been tapping debt markets a lot to borrow money to build more data centers. They're not alone in doing that. A lot of the big tech companies are raising more debt to do it. But a credit default swap is a way that investors basically insure their debt. They get paid if a company defaults on their debt. The cost of Oracle's credit default swaps at their highest level since 2007, right at the start of the GFC.
So really what the market is saying is we have no confidence in Oracle.
And we're nervous about the sustainability of this AI data center story more generally.
Yeah. So one of the other big, I would say, losers of this AI pullback story and the nervousness that was coming through was Leopold Aschenbrenner. Now, he is, for those that are unaware, 24-year-old, I think he is now, 25.
I think he's just turned 25.
25-year-old German investor who, ex-OpenAI employee, made headlines by running a hedge fund that was up something, almost 440%, I think it was, in the last 12 months or thereabout.
No, even shorter than that, up 439% in the 6 months to June.
Oh, there you go. And turned something like 200 million into a few billion, 13 billion or something like that.
Over a couple of years.
Over a couple of years. And so he was betting on the bottlenecks in the AI, I guess, infrastructure.
Yep.
But he did it with a lot of leverage. And when you have short periods of intense falls in the stock market, you're going to get a margin call. And this is what happened to Leopold. He got margin called and he had to effectively close the fund because he wrote to investors and said, Now's a good time to double down, and investors didn't give him any money to, I guess, shore up the fund. And he was taken out by Ken Griffin.
Yeah.
Came in and saved him. And this was the day before his wedding that this eventuated.
Yeah.
So
it's a fascinating story. There is a story going around Wall Street that Ken Griffin orchestrated. Like he saw that Leopold was in trouble, saw that Leopold was asking investors for more money. And then Ken Griffin did a media tour that week leading up to the Fed's decision on rates, and was really talking about how we're going to see a rate rise.
No way.
Yeah, it reminds me a lot of how Bill Ackman got in the media around COVID, and he had a position and then he was talking about how the market's going to fall more. Okay. Do you remember that?
No.
Okay.
Yeah.
Anyway, Ken Griffin was like doing the media rounds, talking about rate rises. Rate rises are bad for high-flying, unprofitable tech stocks.
Yeah.
And so they were saying that was like really, that made a bad week worse for these stocks. And that was kind of like the last gasp for Leopold. And so then Ken Griffin went and bought his whole public portfolio.
Oh, goodness.
Leopold's, he's cleaned out his whole public portfolio, still has a massive stake in Anthropic, and so is still up a lot in that.
Yeah.
But yeah, it's a reminder of you can be directionally right and you can blow yourself up with leverage.
Yeah.
Or just not accounting for the volatility that comes.
Yeah.
Anyway, fascinating story. You actually did a full straight to camera Equity Mates Explains video on that. That's a new YouTube channel we have that we're trying something different. So we'll include a link in the show notes, but worth checking out if you want to see the full Leopold story. Leopold wasn't the only person that got wiped out by highly leveraged trading on high-flying AI stocks. The country of Korea got wiped out. And that is not as much hyperbole as you think it is. Goldman Sachs estimate 1 in 30 Korean adults received margin calls.
Yeah.
Because of this tech wipeout. The two high-flying South Korean companies, Samsung and SK Hynix, South Koreans have been piling into those.
With a heap of leverage. Yeah. And we spoke about this weeks ago on the show, that the biggest risk here is that the country does get wiped out because everyone's just so levered up. It's wild. So 1 in 30 is just crazy.
Yeah, 3.4% of the adult population got a margin call.
Oh, my goodness.
So that was the situation leading into earnings season.
Yeah.
There was a lot of nervousness. At the same time, there were a few signs that the AI bubble wasn't done with yet. The first was spending commitments from big tech continued to be raised. The hyperscalers were close to $800 billion in commitments for 2026. Goldman estimate $920 billion for 2027. Morgan Stanley estimate $1.1 trillion for 2027. So despite the market being nervous about how sustainable these commitments are, Wall Street expected the commitments to not only continue but grow. And the other sign that AI was still a story worth being involved in is the capabilities of the models themselves.
Yeah.
And this was quite a scary story, but it shows just how much they continue to develop, which is all these models that were in sandbox testing environments are breaking out, deceiving humans,
It's crazy.
hacking into other companies. OpenAI had one. I think Sam Altman said it was like the first security incident that shocked him or something like that. And then Anthropic reviewed their testing environments after OpenAI, and 3 of their models had broken out and hacked other companies. The pace of intelligence development continues unabated.
It's just a race to AGI.
Yeah, of course.
And it's like whoever wins that, they're just going to keep spending until one of them comes out and cracks it, and then the rest are just going to be absolutely pumped.
Yeah. People look at this spending commitment and say it's irrational. The counter argument that you hear from some in Silicon Valley is, let's say artificial general intelligence is a super intelligence. And as soon as you have one super intelligence, you can create infinite numbers of super intelligence.
Yeah.
If you have a 1% chance of being the first to get super intelligence, how do you price that?
Yeah, exactly.
How do you, and if maybe this is a rational spending level on the slight chance you get there. That's like the argument that some say to justify this spending.
Yeah.
Others just say the use cases for AI will continue to develop and corporates are going to save money and generate new revenue, and have you seen earnings season, and
It's still
you don't need AGI to justify this spend.
Yeah.
Anyway, That was all leading up to earnings season. Then, while you were floating around Italy and the islands of Greece, we actually went into earnings season. So let's get into that.
Well, the results have been good. 86% of companies are beating estimates. That is well above the 5-year average of 78%. The S&P 500 is on track for 47% earnings growth. That's incredible. That is despite all the macro headwinds that we will get to in a moment. All 11 US sectors are on track for positive revenue growth. 10 of 11 are on track for positive earnings growth. And 8 of those are in double digits earnings growth. So of everything that we've just said, it's like everything's rosy.
Yeah, I mean, some of the sectors, energy so far, 128% year-on-year earnings growth. Communication services, which is obviously a lot of tech, 112% year-on-year. Information technology, 65%. Healthcare is the only sector reporting a year-on-year earnings decline. As a result of these sort of headline results, the US market has hit all-time highs. Yeah. Europe has hit all-time highs. Australia has hit all-time highs. So there's a lot that the market is liking.
Yeah.
I think as we get into the results, let's start with big tech, but then let's move on to some of the other numbers. The story out of big tech is not just growth, but accelerating growth.
So let's start with Alphabet. Revenue grew 24% to just under 120 billion. That's its 12th consecutive quarter of double-digit revenue growth. Cloud revenue up 82%. They have a backlog of $514 billion in, orders for its cloud. It was the first time that they had negative free cash flow in the quarter. So they had negative cash flow of $6 billion. However, their profit rose 298% to $112 billion.
And we should say that $112 billion of quarterly profit, and keep in mind they made $120 billion in revenue.
Yeah.
It's not that they had a 90-something% profit margin. It's that of that $112 billion in profit, $98 billion was from investment gains. And the biggest drivers of that was Anthropic, which they own a meaningful chunk of, and SpaceX, which they own a meaningful chunk of.
So then Microsoft, it's Azure business, their cloud business up 43%. They have a backlog of $678 billion. So again, massive cloud story there. Amazon, they celebrated their first quarter of $200 billion in revenue. It's just, these numbers are just wild. AWS growing 37%, its fastest rate in 18 quarters. And they have a backlog as well of $496 billion. So all three of these hyperscalers have over $500 billion each in cloud backlog.
Yeah, together it's like rough $1.7 trillion between the three of them. Now, there has been some reporting in the past week about the backlog is largely driven by two companies, Anthropic and OpenAI. And so that creates like a customer risk if either of those companies fall over. If they don't fall over, then there's years of data center demand there.
But the big story was Apple. So they were back to the biggest company in the market.
Yep.
Revenue up 16%, earnings per share up 29%. iPhone, Mac, and services all had record quarters, and every geographic segment grew at double-digit rate. But the story with Apple as well is the market love that they're not caught up in all of this huge CapEx expenditure that the other hyperscalers are doing. Apple is sitting back and just saying, guys, you go for it, and then we'll be the distribution for whichever model is the best. Yeah. And the market loved that. They were back at, sitting pretty at the top of the S&P 500.
Yeah, they were. Now, a reminder of how volatile the market is. Even in the past 5 days, as we record, Apple's down 7%, Nvidia's up almost 14%. Nvidia is once again now the biggest company. Releasing tomorrow, I had a really interesting conversation with Sam Ruiz from T. Rowe Price, and we actually had a bit of a debate around Apple, talking about like its strategy of not investing in AI. Was it a good decision? Was it not? So that'll be out tomorrow if you're listening to this the day it's released.
Yep.
But yeah, that it was a good exploration of some of these big tech numbers.
Yeah, it's fascinating. And then let's move to SpaceX. You mentioned it, Ren, $8 billion in revenue for the quarter, up 92%. That absolutely smashed analyst expectations. And then their CFO came out and said that they'll be on track for a run rate of $100 billion by the end of the year.
Yeah, notably for me, for SpaceX, their net loss almost halved as well, from about $1 billion a year earlier to $541 million.
Yeah.
So what you want to see if you're a SpaceX investor is the company get to profitability.
Yeah.
What investors didn't like is that AI capex more than doubled in the quarter, up to 16 billion.
And you've got to remember that Elon is pitching this at the moment as an AI company.
Yeah. Put it in context, Google's going to spend about $230 billion this year on AI data centers, or on capex generally. Most of it is going to AI data centers. So 16 billion in the quarter for SpaceX is still a fraction of what some of the bigger guys are spending. But SpaceX sold off after its results, and this is the reason was the AI spending.
Another notable thing for SpaceX is their Starlink business. They increased users, but total revenue for the business declined because they are now getting into developing markets where their subscription prices are less. So I guess something to watch.
Yeah, long-term play though. Like if you can become the internet service provider of choice in countries,
Yeah. The number of Starlinks I saw on boats and restaurants and whatnot throughout Greece, and it's just a reminder of how vital that, well, not vital, but like it's just such a great service. Yeah.
Oh, is that how you're going to justify this as a work expense?
Yeah, absolutely. So Starlink.
SpaceX research. Yeah. So I think that probably puts a bow on the big tech and AI part of this conversation. The market seems to have relaxed a little bit after that set of earnings, and a lot of the big tech companies either reaffirming their capex guidance and a lot of them also raising their capex guidance. So they're saying we're actually going to spend more money on AI data centers than we previously thought. And what we saw is a lot of the SOX index companies, the picks and shovels plays for data centers, have all rebounded a little bit in the post-earnings glow. We'll call it that?
Yes.
Yeah. So I guess the AI story, we take a deep breath out, we exhale, and we say, see you all again next quarter to see how it's going.
Big time.
But while that was happening, a hell of a lot of other companies had some pretty impressive results.
So, Ren, we'll start with two stocks that are in our community portfolio.
Nice.
So we've got Caterpillar. It had a record quarter of $20.5 billion in revenue. That's up 24%. So great that is sitting in our portfolio. Not great for Michael Burry, who had been shorting the stock.
Yeah, the stock's up 100% in the past 12 months.
Ouch. And then GE Vernova, another company in our portfolio, orders rose 88% to $24 billion. That's a revenue increase of 22%. And they have a backlog of $176 billion. So two stocks from the community portfolio that have had a great quarter.
Yeah, GE Vernova up almost 60% in the past 12 months.
Love that.
So a couple of other stocks that caught our eye, just some interesting stats. Mercado Libre, full disclosure, in my portfolio, it had its 30th consecutive quarter of 30% or more revenue growth.
So good. The stock just needs to catch up. That's
the share price hasn't done as well.
Yeah.
But the underlying business going crazy.
Amazing.
Speaking of businesses that keep growing, Palantir, second quarter revenue was up 93% year on year. It's Rule of 40 score, so it's free cash flow margin plus its revenue growth, which is a metric that we use for a lot of software companies. Above 40% is considered good. Palantir, 155%.
Crazy. So despite all of the news around AI, Ren, not all companies have done well in the space, I should say. IBM has somehow fumbled the ball.
Yeah.
Shares have fallen more than 20%. Mainframe revenue has dropped 42% year on year.
Yeah.
Not ideal.
A couple of other AI-related companies that reported recently that have done well. AMD reported record revenue, $11.5 billion, up 50% year on year. And Taiwan Semiconductor Manufacturing Company, its revenue rose 34% in US dollar terms. Net income, profit increased 77%. And its net margin, its profit margin is 55.6%.
What a company. What a company. Now, something that I've had my eye on, Ren, you know that I've got the Banks ETF in my portfolio, BNKS, which is good news because all 5 major US banks beat analyst expectations. JP Morgan had its best quarterly profit ever of $21 billion. And Goldman Sachs nearly doubled its earnings per share as well. So great news for the big banks.
Yeah, and like the hits kept on coming. Oil companies also had a record quarter, largely driven by Iran, obviously, and higher oil prices as a result, to the point where President Trump came out and said big oil companies were, quote, making too much money. And it's hard to argue with the president on some of these numbers. So Exxon reported its highest quarterly profit in 4 years, $14.5 billion, more than double its quarterly profit same time last year. Meanwhile, Chevron reported its highest quarterly profit in 6 years, up 385% year on year.
Wow.
You know what's annoying? I sold the oil company's ETF in our portfolio competition. Yeah.
Damn.
All right.
Lesson learned.
Let's take a break here. Let's take a deep breath. We've ripped through so much information on earnings season and the AI story. On the other side, maybe let's talk about the less rosy part of the market, which is the macro picture, and then bring it home to Australia. But let's take a break and regather our thoughts.
Welcome back to Equity Mates. We are doing a recap of the last 5 weeks as I've been on holidays. We've gone through, I guess, the AI story and then some of the companies in detail from earnings season, but there's been a lot at a macro level that has been driving markets as well. And we've got to start with Iran because it's been a bit of a seesaw over the last 5 weeks. Unfortunately, conflict resumed off the back of a pretty weak memorandum of understanding between Iran and the US. Iran struck 3 commercial vessels and the US retaliated and started striking. So the ceasefire is over. They're back in some form of negotiations, but the Strait of Hormuz is back to closed. And the oil price, from memory, got back up close to 100, but is now back down again at around 75, 76 US dollars a barrel.
There's a theory that Iran restarts the war when it gets close to 70 and Trump declares a peace deal when it gets close to 100.
It's unbelievable.
Yeah. Look, let's not speculate on where the status of a deal will be by the time this episode comes out, because it changes day to day.
Yeah.
But obviously that still remains the biggest challenge in markets. And if you look at charts of inventories, like they are really starting to drop again.
Yeah.
So oil inventories. So not ideal, obviously. That's not the only challenge in the macro picture though. Inflation remains a concern, partially driven by the Iran war and higher energy prices, but not completely driven by Iran. US inflation has been above its 2% target for more than 5 years. So obviously predating Iran. Really, since the COVID inflation wave, inflation hasn't got back to target in a lot of countries. In Australia, it briefly got back to target, but then is now above target again. It's one of the biggest concerns in markets. In the US, the Fed voted to hold rates in late July, but it was contentious. 3 of the 12 votes were for raising rates, and those 3 governors actually came out and vocally dissented afterwards, saying America needs to raise rates. And adding to the inflation story, Trump put more tariffs on after the Supreme Court overturned his previous tariffs. They expired. His 10% global tariff expired on the 23rd of July, and he immediately put on new tariffs under a new law that cover 60 trading partners, including Australia, that cover 99.4% of US imports. So effectively, net, put them back on.
Yeah.
So the macro picture in the US is pretty bleak.
Yeah.
Consumer confidence is low. And that really stands in stark contrast to the bonanza that we spoke about on the share market.
Well, it's just a reminder that the stock market is not the economy.
Yeah.
You just cannot try and put the 2 and 2 together because you'll be misguided.
Yes. But at some point, if the economy stays this weak and consumer spending stays this weak,
it does.
The share market will be impacted.
Yeah.
But it's just that a lot of the US economy is being propped up by data center spending at the moment.
Yeah. Bringing it back to Australia, where inflation is also still an issue. The 4 major banks, though, predict that rate hikes are done for 2026. However, the RBA has not ruled out further increases. The next decision is this Tuesday, August 11. So it'll be interesting to see what plays out there. But Ren, while I was away scanning headlines, the story for Australia was really house prices.
I was going to say there was probably 3 that you needed to know, which is budget remains controversial, One Nation surges in the polls, and property prices soften slightly.
And the 4th was Essendon is still shit and we haven't found a coach.
Although you did beat GWS.
we did beat GWS, yeah. But house prices was the story. House price every week. So what did you pick up? The rate of house prices falling in Sydney and Melbourne particularly is increasing. Auction rates were falling. No one was showing up to auctions. And really, I guess from like what the government wanted to achieve is now we're seeing more stories of first home buyers actually coming in and picking up housing. But like, I think they don't want to come out and say that we've achieved what we want, which is house prices falling.
No, Tanya Plibersek came out and said, like, this is the best time to be a first home buyer. And I get it, like the market is softening, but prices, are still wildly out of step with incomes. Like, if we actually want housing affordability to be a thing, we should expect further falls.
Absolutely.
Yeah. To give you a sense of the numbers, national property prices had their biggest monthly fall since 2022 in July. So they are falling. It was just Sydney and Melbourne where prices were really falling, but it's broadened out. Brisbane and Adelaide recorded their second consecutive month of falls. I think it was only Darwin that went up in terms of the capital cities, but nationally property prices were down 0.7% in the month.
Yeah.
So not a crash by any stretch of the imagination.
No. Combined average of 2.5% for 2026 across capitals.
Yeah.
Sydney, I think, is 5.5%, and Melbourne also about 5.5%. So they're falling.
Yeah. What else did you miss? EV sales surged.
Nice. Didn't see that one.
In the June quarter, 1 in 2 cars sold in Australia were EVs or hybrid.
Wow.
Yeah. I think that's notable.
That is. No doubt it's been a big 5 weeks. Key takeaway for me, though, is if I look at my portfolio when I left, I look at my portfolio when I'm back, I mean, markets are at record highs. So if you had tried to play that...
Here's the question. If you net off what you spent on your trip and what you made from your investments, did you make money?
Probably net.
Okay. I mean, look, it's a reminder for me that like trying to time the market at the moment is a fool's game. It's always a fool's game. But when it's this volatile, trying to buy in and out of indexes or stocks is just crazy because it is so volatile. But what we can see is that the market continues to grind higher, driven by everything that's going on in not just AI, but just the broader market. In fact, the equal weight S&P 500 index has actually beaten the market cap weight S&P 500 this year, which is a sign that it's not just tech stocks driving this rally.
Yeah.
So...
just be diversified. Buy the index.
Yeah. Keep investing.
Enjoy the ride.
Don't try and time the market. Go on a 5-week holiday to Europe.
Exactly. Well said. Well, we'll leave it there. A reminder to grab your FinFest tickets because, as we said at the start, 75% already sold. Big announcements to come on what to expect on the day, but it is going to be absolutely fantastic. So don't miss grabbing your ticket. It's good to be back, Ren. Always great to chat stocks, and we'll pick it up next episode.
Sounds good.
This podcast is intended for education and entertainment purposes only. Any advice is general advice and has not taken into account your personal financial circumstances. Before acting on general advice, you should consider if it is relevant to your needs. If unsure, speak to a financial professional. The host of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media is part of the BetaShares Group but maintains editorial independence. We operate under Australian Financial Services Licence 540697.